Friends, can you believe it? The future of AI may not be limited by chips, but rather by electricity. That sounds a bit exaggerated, doesn't it? But this isn't alarmist. Many people focus on computing power, graphics cards, and Nvidia, assuming that the future will be a competition to stack chips faster. However, the real bottleneck may be hidden in the most inconspicuous place, the electric meter. Electric meters don't lie. They record real consumption. No matter how advanced technology becomes, it will ultimately be driven by electricity. Without electricity, even the most powerful chip is just scrap metal. Hi, I'm Daryl Hart, a finance blogger. Imagine spending a fortune on a top-of-the-line graphics card, plugging it in, and then having the power go out and darken the entire room. You feel like a technological pioneer, but end up looking like a helpless clown. The US AI industry currently faces a similar dilemma. Its appetite is astonishing, but the power grid is aging and vulnerable. 70% of America's power transmission lines are over 25 years old. What does this mean? They've long since entered their old age, like a clunker truck forced to haul high-speed freight with hundreds of thousands of kilometers on it. At this very moment, AI's appetite is frighteningly voracious. Data centers operate 24/7 and consume dozens of times more electricity than an average office building, making them complete power hawks. According to global projections, data centers alone will consume 8% of the world's total electricity by 2030. Don't underestimate this number. It's as if 1 out of every 10 lights in the world is burning solely for AI. The U.S. Department of Energy has offered a clearer picture. Over the next 5 years, the United States' overall electricity demand will increase by 25 to 30%, with computing power centers consuming over half of that. Can you imagine? On one side is the struggling power grid, and on the other is the ever-hungry AI. The conflict between the two is like pulling a high-speed train with a dilapidated bus. How could it possibly go right? If this gap isn't filled, the consequences will be dire. AI development could stall, manufacturing won't be able to relocate smoothly, and the US economy could be crippled by electricity shortages. This isn't an exaggeration, it's already happening. In states like Texas and Virginia, where data centers are densely populated, many new projects are waiting for power. Some companies have even had to shelve expansion plans due to a lack of approvals for power connections. The problem isn't capital or chips. It's that the socket simply can't accommodate more appliances. It sounds ironic, doesn't it? This is today's greatest contradiction, an outdated power grid and exploding demand for AI. Some may think this is only an issue in a limited industry, but when viewed from a global perspective, the severity of this crisis becomes even clearer. In China, for example, an increase in electricity consumption often signals a recovery in manufacturing, with electricity serving as an economic thermometer. But what about the United States? Although electricity demand is rising, infrastructure is lagging behind, leaving the power grid as the weak link. While we often talk about the future, a potential electricity shortage could undermine our ambitions for AI. Then again, crises are always a sensitive signal for investors. Smart money has already started moving. While many are fixated on chip stocks and wondering if Nvidia will continue to rise and if AMD can chase higher prices, institutional investors have begun shifting their positions. They are quietly moving out of chip stocks, which have valuations exceeding 30 times and are subject to extreme volatility, and into power and infrastructure stocks, which have valuations of only 15 to 25 times and provide stable cash flow. Why? Because chips can be purchased later, but electricity must be replenished immediately. Without electricity, AI is a castle in the air. Wall Street has realized that power and infrastructure are the true foundation of this AI wave. Furthermore, the US government has begun to take action. New energy sources are emerging rapidly. Solar power's share of installed capacity continues to rise, establishing itself as a core component of the future energy transition. Wind and hydropower are also growing. The adoption of virtual power plants, energy storage technologies, and smart grids is improving energy efficiency and prompting industrial upgrades. Large-scale efforts to bring manufacturing back to the United States are increasing the demand for industrial electricity and prompting upgrades to the energy supply chain and infrastructure. The Trump administration has relaxed energy regulations, supported the development of the oil and gas industry, and promoted diversification in the energy market. Government subsidies, tax incentives, and infrastructure legislation are providing investment opportunities for energy companies and related ETFs. Against this backdrop, energy-related ETFs such as SLE, which cover traditional and new energy companies, have become a focal point of market attention. Recent signs that the decline of major energy stocks in these ETFs has halted indicate a gradual recovery in market confidence in policy support and future growth. In other words, policy and capital are working in tandem. To better understand this logic, imagine the power industry as a giant machine. It has four gears: power generation, transmission, distribution, and consumption. In the past, this machine operated steadily. However, the addition of AI is like adding a turbine. All four gears accelerate simultaneously. The power generation gear is large and requires a long cycle, but the infrastructure is stable. The transmission gear is large-scale and highly deterministic. The distribution gear quickly starts and receives a large number of orders. The consumption gear is closest to the market, particularly electrical engineering in data centers, and is implemented quickly. Consequently, the entire machine speed has increased by a factor of 2, and the gears are beginning to creak. This presents a contradiction as well as an investment opportunity. The question on everyone's mind at this point is probably, which companies will actually secure the orders? That's where the money is. Here are the names: Mir Group, Primoris, MCore IES Holdings, and Vilden. You may not often hear these names, but they're popular choices for institutional portfolios. Mir Group and Primoris have clear advantages in the power transmission and distribution sectors and enjoy a steady stream of orders. MCore and IES Holdings specialize in electromechanical engineering, particularly electrical integration projects for data centers. Vilden excels in energy-saving retrofits and energy storage, which aligns well with favorable policies. These companies share common characteristics: ample orders, rapid growth, and affordable valuations. They trade at price-to-earnings ratios ranging from 15 to 25, and their cash flow is stable. Compared to chip stocks, which often trade at price-to-sales ratios of over 30, these stocks' advantages are immediately apparent. Given their affordability, risk resistance, and access to government subsidies, smart money will naturally prioritize these stocks. Furthermore, breakthroughs in energy storage technology and the development of smart grids will significantly improve energy efficiency, reduce costs, and upgrade the energy industry. In the future, a new market trend will emerge in which businesses build their own power plants and develop energy storage systems. Companies like GRNC will benefit from this trend as well. However, the rapid development of new energy sources has brought challenges to water resource utilization and environmental protection. Technological innovation and policy guidance will ensure an adequate energy supply while balancing environmental sustainability in the future. In short, the U.S. energy market is undergoing a profound transformation. The integration of traditional and new energy sources, upgrades to infrastructure, and policy support will promote the industry's long-term development. As you can see, the logic is quite sound. What is the crisis? The contradiction between America's aging power grid and the surging demand for AI. This contradiction has elevated the strategic importance of power infrastructure. The turning point lies in the dual forces of policy and capital. The conclusion is that capital is quietly shifting from chips to power infrastructure. The AI dividend extends beyond silicon wafers and benefits the power grid as well. In the short term, chip stocks may shine brightly, but in the long run, those who truly reap the rewards are the hardworking craftsmen of power infrastructure. Imagine a race. Chips are the sprint stars of the 100-meter race. They run fast, but with a high risk of failure. Power infrastructure, on the other hand, is like a marathon runner. They may not be as fast, but they can steadily complete the race. The sustainable development of AI cannot rely solely on sprint stars. It must also be supported by stamina-rich craftsmen behind the scenes. This is why Wall Street is adjusting its portfolios. Chip stocks are constantly hyped in the news and are already the focus of the entire market. However, the real opportunities may lie in power companies that few are willing to consider. A constant rule in the capital market is that while the public is chasing the stars, the smart money has turned its attention to the craftsmen. The investment opportunities of the coming years lie right here. Upgrading the U.S. power grid and expanding power infrastructure aren't minor fixes, they're systemic overhauls. Coupled with the rise of new energy sources, the growing popularity of electric vehicles, and the reshoring of manufacturing, these factors are coming together to set the stage for a significant shift in the power industry. The computing power demands of AI will ignite this cycle. Therefore, if you're focusing solely on AI chips, you're only seeing the tip of the iceberg. Electricity is the real determinant of AI's continued rapid development. Power infrastructure is the vast, deep-seated root system. No matter how lush the branches and leaves are, they will eventually wither without roots. That's all for today's video. If you found it helpful, please like it to show your support. Your support really helps the channel. Don't forget to subscribe and turn on notifications so you won't miss my latest updates on the market and investment strategies. I'd love to hear your thoughts. Tell me in the comments whether you prefer sprint stars or backstage craftsmen. Friend, remember this: the future of AI does not lie in silicon chips, but in the power grid. Whoever seizes this wave of power infrastructure development first will reap the benefits for the next decade.